This is your macroeconomics video on the federal funds rate. The federal funds rate is the interest rate on loans that banks make to other competitor banks. So from time to time, a bank assumes how much money they're going to need in excess reserves for the amount of customers that they plan will come in for withdrawals or deposits. If it turns out that more customers need to withdraw money than they had planned for, they have insufficient reserves because they can never dip into the required reserves. So they have to borrow either from the Fed, that would be paying the discount rate, or from a competitor bank, which is the federal funds rate. Generally, of course, they prefer to borrow in the free market from another bank. But the government requires that if one bank borrows from another bank, they have to charge the federal funds rate. This is partially in order to ensure that we have a free market competitive banking system. If one bank wanted to screw over a competitor, then they can charge them massive amounts of interest and thus put them out of business. And we don't want to do that. We don't want a monopoly in the banking system. We want a robust free market. So the federal funds rate is bank-to-bank loans. You typically only want to do this for really short-term loans, 1 to 2 days. And again, it's typically because a bank just, miscalculated how many people would withdraw funds. So they only need a loan for 1 or 2 days. They pay it back easily at the federal funds rate. The federal funds uses open market operations, which is the buying and selling of federal government U.S. bonds, to target the federal funds rate in the open market. The Federal Reserve or the central bank can't actually set the federal funds rate. It's a free market, so there's supply and demand. So here is a federal funds market graph. It's a typical supply and demand graph. On the horizontal axis, you have the quantity of funds available. So this would be the amount of money, quantity of money in the open market. The federal funds rate is the price that you're going to borrow at. And then there's, of course, a supply of funds, and then there's banks who are demanding the funds. So based upon whether you're going to loan it out to somebody or you're going to have to demand or borrow it from somebody. Based upon how many banks are demanding funds from other banks and how many banks are willing to supply those funds to them, it sets a free market. So let's say that the current federal funds rate is 3.5% on a 2-day loan. If it suddenly turns out that there is only a few banks who are willing to supply, but the demand for borrowing money from another bank at the federal funds rate rises, if demand shifts to the right here, your federal funds rate would go up. Typically, the Federal Reserve, if they want to get into the free market and alter this federal funds rate, they can do that by using open market operation. The Federal Reserve can go into the system and sell government bonds to people. If they sell bonds to people, people are going to give the federal government their money today, thus removing it from the banking system. When the Fed removes the money from the banking system, then the supply of funds in the banking system goes down. This will shift supply to the left, and that will also cause the federal funds rate to rise. So although the Federal Reserve does not set the federal funds rate, they can affect it by using their power in the free market to sell open market operations or government bonds.